Welcome to the lecture on Introduction to Cost of Capital and Ratio Analysis. So, in this lecture we are going to have the knowledge about the cost of capital before and after tax, the cost of capital, what it is, and what are the different ratios which are required to analyze in the case of the this cost related to capital. So, that we will discuss in this lecture. Now, the cost of capital is a crucial concept in financial decision making, and it is the criteria by which a firm would decide whether an investment can or cannot potentially increase the firm's stock price. So, basically it will help you in making that decision, and it will be defined as, that is, the rate of return that the firm must earn on its investment to maintain a proper market value for its stock. So, that will be one thing which will be required, and then also the rate of return that the investor must require to make its capital attractive for rewarding the investment opportunities. So, certainly the the investor will try to reward the person who is purchasing the stocks or the shares of his company. So, he will try to reward him, and how much return the investor must be getting. So, that certainly is one point which is in his mind. Now, we must be knowing that what is the before and after tax cost of capital. So, and also the weighted average of cost of the capital. So, if we try to define the so basically the firm will be using the those firms which use the long term debts, so if the firm is using these long term debts bonds, selling bonds to finance its corporation, its operation. So, in that case you can calculate the before tax cost of debt. So, the before tax cost of debt can be computed in those cases when the firm is using that long term debt by selling bonds. So, in that case before tax cost of debt, that is known as CCB. So, that is basically found as the I plus then M minus NP, and then divided by N, and then that will be divided by NP plus M by 2. So, the average of the NP plus M. Now, what are these values? So, here first of all we must know that this CCB, this is the cost of capital of for bonds. Now, for that I is known as the annual interest, then M is the face value of the bond. So, M is the one which is known as the face value of the bond. Similarly, NP. So, NP basically will be the net proceeds, and then so that's what it is. So, net proceeds is nothing but, so that is it is the face value adjusted to flotation cost. So, basically you have to take into account this flotation cost or obligations, then you will have the net proceeds, and N is the number of years to redemption. So, once you know these values, then you can find the before tax cost of capital for the bonds. Let us say for example, suppose you have a if some one corporation is there and it is planning to collect a capital, say corporation planning to collect capital. So, capital of suppose say 50 lakhs. Now, so it will be by selling its bonds. So, it will be selling bonds of 1000 8.5% coupon rate. So, that is the bonds of rupees 1000 and the coupon rate will be 8.5%. Now, the firm is selling at a discount of rupees 30 per bond, and also the flotation cost that is involved. So, flotation cost is 2% per bond. Now, if you have to find the before tax cost of the capital and also given the 20 year. So 20 years, find 20 year for 20 year the before tax cost of capital. So, suppose you are to find say let us say the before tax cost of capital and n becomes 20 years. So, if you look at this, in this case you need to find all these parameters, like you need to find I, m, n, p, n is 20. So, that way you can find. Now, I, if you look at, if you have to find I will be 8.5% is the coupon rate. So, your 1000 multiplied by 8.5%. So, it will be 85. So, that will be your I. Then the expression is m minus np divided by m. M is the face value of the bond and np is the net proceeds. So, the if you look at the m is basically given as 1000. Now, if you look at this discount is given as the 30 per bond. So, your bond discount is so that's why the BD will be m minus D, that is discount. Discount is given as 30. So, it will be BD will be 970. Now, the net proceeds basically will be because your flotation cost is 2%. So, net proceed will be 2% will be subtracted. So, it will be 0.02 times 970 and that will be subtracted, or you can multiply with 0.98 to 970 and it becomes 950.60. So, that becomes your net proceeds, and this is the face value of the bond because it's giving a discount. So, your face value is becoming so this BD becomes m minus D. Now, what is happening that you have to find this before tax cost of capital. So, that will be I plus, so I will be your 85, then you have to have the difference, that is the face value anyway is 1000 and net proceed is 950.60 and this will be divided by 20. So, that is on the numerator, and then in the denominator you will have the 950.6. So, and then you have 1000 is the face value. So, that m and this divided by 2. So, what you get is, in this case you are getting a value of 0.09. So, what you can write coming to the interpretation of the value of CCB as 0.09, it can be written that the before tax the cost of capital is 9%. Okay. So, if you have to find the after tax cost of the capital, now for the finding the after tax cost of capital, you have to know the tax rate, and if you know, so for finding the after tax cost of capital, now after tax cost of capital, for that you need to have the value of the tax rate. So, after tax cost of capital, that is CCA, and it will be before tax cost of capital multiplied by 1 minus T. So, that T is the corporate tax rate. So, once you know the corporate tax rate, in that case once you have found the cost of capital before tax, so after tax it will be something like 1 minus T. So, suppose it is if T is suppose given as 39%, in that case so in this case CCA will be 9% multiplied by 1 minus 0.39. So, that way it will be 61 and into, so 0.61 into 9, so it will be 0.055. So 9% it is. So, that will be 5.5%. So, it will be 5.5%. So, that way you can calculate the after tax cost of the capital also. So, this is about that. Now, we will discuss about the different terms like also like weighted average. So, we had also said one is the weighted average cost of the capital. Now, if you come to the weighted average cost of capital, now this weighted average cost of capital, it is, so as the name indicates, it will be taking the weights in fact. Now, in this case the cost of capital for the weighted average, it will be a summation of I equal to 1 to n, and this will be WIKI. So, you have in this case this CCWA, this is basically the cost of capital weighted average, and the WI, and now in this case the WI is basically the proportion of any type of capital, and the KI is the cost of any type of capital. So, in the firm's capital structure, you will have different types of the capital in the in the firm, and it will have certain proportions. So, that way you will get the WI and also the cost of that particular type of capital. So, if you get the summation of all of them, so that will be telling you the cost of capital weighted average. So, that can be understood by again one example, say if you have a corporation's capital structure is there. So, suppose a corporation's capital structure and the individual costs are like this. So, the corporation's capital structure and individual costs So, if you look towards the different capital structure and individual costs, suppose the long term debt, it will be taking 38% of capital structure, and costs 5.59%. So, suppose the long term debt which is taken, it will be the 38% of the capital structure of that corporation, and it will be costing about 5.59%. Then the preferred stock, so that preferred stock will be representing, so that represents 14%, and it will be costing 9.62%. Similarly, you have the common stock in the end, and the common stock takes remaining 48% and costs about 12.35%. So, this is the capital structure, corporation's capital structure, and also the individual cost. So, if you have to find, so you have to find the corporation's weighted average cost of capital, corporation's weighted average cost of capital. Now, and we will try to also interpret what does it mean. So, if you try to find these corporations weighted average cost of capital, so you can have a table, and what you see is that you have the long term debt which is taking 38% of capital structure. It costs about 5.59%. Similarly, preferred stock 14% costs 9.62. So, your WI and KI. So, WI is in this case you have 0.38 and this is 5.59%. So, if you find the CC the weighted average, in that case you have to see that it is done with from I equal to 1 to 3. You have 3 types of the long term debt and preferred stock and common stock, and you have to multiply WIKI. So, these values are given, and you can multiply and then you can add. So, if you add them, it becomes 9.4%. Now, the value of 9.4%, that will be basically coming as 0.38 times 0.0559. Similarly, so that will be 0.38 times 0.0559 plus 0.14 times 0.0962, and then if you take 0.48 times 0.1235. So, if you take its sum, so that comes out to be 0.094. So, that is what it is, 9.4%. Now, it means that the as this so this will be basically the weighted average calculation, and in this case this 9.4% this return, it tells that corporation will be able to accept all the investment projects. It will be able to accept if that earns more than or equal to this 9.4%. So, that is if it is less than that, then certainly it will not be able to sustain. So, if it if it is able to earn more than that, then the corporation will be able to accept all the investment projects. So, that is what the meaning of the corporation's capital structure and individual costs, and based on that how you find the weighted average cost of the capital. Now, we are going to discuss about the ratio analysis. Now, what happens that in many of the in this investment sector, many a times you wish to compare that how you are getting the returns, and there are different ratios which are defined. Now, these ratios we must be able to we must be acquainted with, which basically there will be many a times we try to see that how much return you are getting, and what is the trend of the returns, what are the risks. So, based on that you have to what you do is there are different types of performance measures which are defined in terms of ratios, and we must be also acquainted with the different type of these ratios. Now, among them you have the ratios like the profitability ratio. So, because these ratios will be addressing the specific type of specific aspects of the performance. So, you will have the profitability ratio or the liquidity and the operations. So, you will have different ratios which are defined basically, and it will be indicative of the performance of the firm. So, we are going to talk about the different type of ratios. Now, first is the profitability ratio. So, if you talk about the profitability ratio, they are also known as the efficiency ratio. So, also called as. Now, they are basically used used to assess basically how efficiently the firm is utilizing its assets and assets. So, it assesses how efficiently firm utilizes its assets and how they are able to attract investors and their capital. So for that this profitability ratio are basically calculated, or efficiency ratios are calculated. Then the next ratio which is very important is the gross profit margin ratio. So, this is also known as so it will be indicated by GPMR. So, this is gross profit margin ratio, and all these ratios are a ratio. So, you will have in the numerator something and in the denominator something. Now, in this case the GPMR basically is basically ratio of GP and NS. So, GP is the gross profit. So, GP will be gross profit. So, that will be sales after paying for the cost of goods sold. So, that will be your gross profit, and NS is the net sales. So, NS will be net sales. So, that will be gross sale minus all goods returned. So, that will be gross sale minus all goods returned. So, that will be your net sales. So, this gross profit margin ratio is one of the ratio which is used to see the how efficient how good the company is. So, suppose if your gross profit is given and also your net sales are given, then you just take the ratio of these two, and that will give you the GPMR. So, the GPMR will tell that for every rupee of the net sale, what is the gross profit. So, if once you have the net sale, then if you are getting 30% as the GPMR, so GPMR is suppose 30%, means 30% of net sale is the gross profit. So, that is what So, larger will be the GPMR, it means that larger percentage of the net sale will be your gross profit. So, that is one of the parameter, one of the ratio which is described. Then next may be operating profit margin ratio. So, operating profit margin ratio, it will be defined as the ratio of in this case you are not taking the gross basically profit, but you are taking the in this case it is this is also represented by OPMR, and it is here you have you take the ratio of OY to NS. So, it will be talking about the operating profits as related to the net sales. So, it will be talking about the operating income, and that way it will be same as the EBIT. So, earning before income and taxes. So, that way you calculate these OPMR, operating profit margin ratio. For example, the if the operating income is say, so if operating income is rupees 45,000 and net sales is rupees 3 lakhs. So, in that case the operating profit margin ratio, it will be computed as 45,000 divided by 3 lakhs. So, this way you can calculate. So, it will be 45 by 300, and it will be calculated as 0.15. So, it means that how much of the net sale will be going to the operating income budget. So, that is what it will be representing. Next the ratio which is again important is the net profit margin ratio. Now, net profit margin ratio, again it is related to the net profit. So, it will be ratio of net profit by net sales. So, you are given the net profit value, and you have net sale. So, that way you can, if there is some percentage is given. So, if the net sale is known to you, then that percentage of the net sale will be your net profit. So, that way you can directly calculate this net profit margin ratio, that is NPMR. Another ratio that is important is the return on investment ratio. So, that is also known as return on investment ratio, ROIR. Now, in this case it will be taken as the total. So, it will be compared to the total asset of the firm, and here you will be talking about the net profit. So, it will be ratio of net profit to the total assets. So, return on investment, that is your total asset must be that is mentioned, and the net profit if it is mentioned. So, this ratio if it is known, and if you know the total assets, then you can say that this will be the net profit of the the organization. So, that is your return on investment ratio. Then there is return on equity ratio. So, this return on equity ratio, that is ROER, and ROER basically it will be net profit, and it will be on the denominator you have owner's equity. So, OE, and this OE is basically owner's equity. So, that way you will have the net profit. So, once you know the owner's equity for both the preferred as well as the common stocks, then it will be telling you that how much of the money of the firm will be going into the profit. So, that way you can calculate these return on equity ratio. Apart from that, you have many types of ratios, like you have sales asset ratio. So, that will be the ratio of so it will be how efficient you are using the resources, and it will be referring the sales to total assets. So, it will be sales to total assets. So, that will be your sales asset ratio. Similarly, you have sales to net working capital ratio. So, that will be sales to net working capital ratio. This will be sales to asset ratio, so SAR. So, it will be, in this case you have to find sales by net working capital. So, that way you have many kind of ratios. You have also ratios based on the market based, and in that case the different ratios are like price by earning ratio. So, price by earning ratio, that will be basically depending upon the market price of the common stock, and then the earning per share. So, that will be your price by earning ratio. So, that way price by earning growth ratio also that is being computed. The terms like earning per share. So, you can calculate like you have price and then earnings growth ratio. So, that will be price by earning divided by the year growth rate, expected growth rate for the year. So, that will be price earning growth ratio. So, this way you will have the different types of ratios which basically come across when you discuss all these things. Thank you very much.